more we think this when we're looking at program that
So again, we usually think of risks, bets, in terms of plus or minus what we currently have. What I'm doing here, I don't want to spend too much time on this because this is actually not a super helpful point. But what I'm talking about here is not a win-lose deal, but just this outcome versus that outcome, which from certain points in the income distribution is a massive gain, some points it's a loss. And that isn't what matters in this model. What matters is simply how do you feel about this final outcome versus how do you feel about that final outcome, regardless of where you started. And the model assumes that the answer is you feel the same no matter where you started from. Okay? So the bottom line has to do with the size of the stakes. And here's what you get. The size of the stakes and the sort of the curvature of this thing. So for tiny changes in x, right, and for a lot of these people in the Barberis, Huang, and Thaler example, these were tiny amounts, trivial. For tiny changes in x, the utility function is almost perfectly linear, right? If I zoom way in on that thing, right, if this is 10 million, if this is 10 million, then 500, 550 is really just right close to that. And so we have to zoom way in, and the closer you get, right, this is the whole point about what we call a first-order approximation. The slope of the curve is a tangent at a point, and if you're really close to the point for infinitesimal changes, the first derivative is actually the slope of the curve. That's the whole starting place of calculus. So what we're really looking at is this, right? We're looking at 10 million plus 550, 10 million minus 500. And we're looking at the utility loss on the downside and the utility gain on the upside. And it damn well better be the case when the thing is that close to a straight line, right? It better be the case that if the dollar value of the upside is greater than the dollar value of the downside, then the util value of the upside better be bigger than the util value of the downside. That's what linear utility means in this model. If there's no concavity, there's no risk preference. You're risk neutral, right? So if we're talking about, if I offered you a bet between like 50% you get that bundle of goods, 50% you get this bundle of goods, right? You guys take that gamble versus nothing, right? Or no, sorry, it would be 50% you give me a piece of chalk that size, 50% I give you a piece of chalk that size, okay? You guys better make the decision about whether or not to take this bet on the basis of the size of the pieces of chalk, right? And not on sort of like some, oh my goodness, if I gave up this piece of chalk, that would drive down my net wealth. And the dollar would mean more to me. So this is a somewhat scary proposition. This will drive up my net wealth by more, but into a region where my marginal utility for extra money is much lower. Hey, we know this is ridiculous. These are just trivial amounts, and you should make the decision of whether or not you want to accept this gamble on the basis of expected value, right? So you should take a gamble. As a matter of fact, you just have the chalk. So that's what's really going on, is that for these small stakes, we're zeroing in on this curve. Right? This is a curve that has to span the whole possible distribution of wealth of the individual whose preferences are being modeled. So necessarily for these tiny stakes, we have to treat it as if it was basically flat. So if it was sufficiently curved, if it was so curved that even after zooming in that tightly, we still saw enough curvature for people to reject that bet, that degree of curvature would mean that the same person would also reject this $20 million gamble, and we know that that's not right. Right? So if you've ever even thought about being worth $10 million, you have to know that you would pay $10,000 for a 50% chance to triple your wealth. Yeah, and by the way, it's not going to happen to you. I mean, I guess you could meet Dick Thaler and maybe he'd make you that offer. Now, I started out by saying this is implausible. Okay, this is one of the assigned readings. So Matt Rabin did this really very impressive thing, and it's one of his, in terms of like intellectual heavy lifting, it's one of his smaller contributions. But in terms of like just really nailing down something very important that the rest of us get to build on confidently, this is a very important contribution. He actually proved mathematically. Go read the paper. I don't actually care that much about the math. I want you to get the intuition. But he proved what I just said about curvature. He proved mathematically things like this. And this is just quote. Suppose that from any initial wealth level, a person turns down like a 100, 110 bet. Then she'll turn down 50-50 bets of 1,000 versus literally any sum of money. Like there literally isn't a big enough sum of money that if the curvature of the utility function was sufficient to explain rejecting that 100, 110 bet, there literally isn't a large enough sum of money that this person would accept a 50-50 bet of giving up 1,000 versus receiving that sum. Okay? Now we don't even really have to think about implausibility. That's just not possible. And there's some other examples. So he says these are implausible degrees of risk aversion. They are so conclusively implausible, they're so profoundly implausible, that even though we haven't sort of, in some completely rigorous, unassailable way, you could say, well, there could be someone out there like that, right? Alex's friend might be that whatever, strange. But it's so profoundly implausible that for the most part we can say, you know what, we know that's proof. That's proof. And so we're going to move on, and we're going to say unambiguously the expected utility model can't explain small stakes risk preferences. Okay, and Ken Arrow, he's a Nobel Prize winner from way back, who, if he's still alive, he's at Stanford, showed something similar all the way back in 71, which is no matter how risk averse you are, expected utility theory says I can always come up with some better than fair bet that you'll accept. So that was this example, right? I can drive the stakes down small enough that eventually you'll take the bet. Okay, unless there's a kink. Okay, unless there's a kink in the utility function. And in particular, it's very helpful if the kink moves around, like follows you around like your shadow, as in the reference-dependent model. So that's our reference-dependent utility function. So let's assume that the reference point here is 10 million. And then consumption in the positive outcome, which I'll just call C high, is 10 million plus 550, C low, 10 million minus 500. And what we get is that basically no matter what scale the x-axis has, regardless of whether this curvature is intended to cover a range of outcomes of tens of millions of dollars, in other words, no matter how far in we have to zoom to get to the scale of a 550, 500 bet, there's always a kink, right? There's always a kink when you zoom in. And this completely changes how this model explains risk preferences. Right? So now what we have is, not sure. Is that twisted on your handout? It is. I need to fix that. Right, so there's C high, there's C low, and you're now very familiar with this. The kink, which is loss aversion, means that this is the downside and that's the upside. Okay. So now I care about this loss for a fundamentally different reason than expected utility. The psychology implied by the expected utility model is fundamentally different than this. Right? I just have this weird thing where I don't like losses, which is very different from this loss is going to make me so poor that the dollars that I lose are going to be worth more to me than the dollars I would gain. everybody get why this is incredibly important to understand the psychology behind that difference? Does that make sense? Okay. All right, which means that even a wealthy investor will reject a small stakes gamble if this is their utility function. Okay. So let's bring this home. The last time you bought a piece of consumer electronics, now answers to this question have changed over the last few years for interesting reasons, but the last time you bought a piece of consumer electronics, an iPhone, a printer, etc., did you buy the extended warranty as well? Okay, 5, 4, 3, 2, 1. Whoops, that's the last question. Come on. Is that this question? That's this question. Is that right? Yeah, that's this question. Okay, so the vast majority of you said no. Let me come back to that. This is a little tricky because my sample size starts to get small. For the other 31 of you, the 31 of you who said yes, the next question is, if you said yes, what do you think is the likelihood of loss or breakage during the period of the warranty of the thing you bought? So this won't count towards participation points, obviously. Will not count towards participation points. I hope you're all pressing E. Okay, good. Now, wait, what do we have? So 26, 37. Okay, well, we got a little pollution in there anyway, but it doesn't matter. So most of you said that you think that the probability of loss is in the 15% to 30% range, which may or may not be correct. It may be on the high side. What I'm finding, and I need to next time I teach the class, I need to actually change this, because what's happening is that people are actually beginning to figure out the thing about extended warranties, which is that they're just like a total ripoff and a really bad idea. So you guys are actually moving towards rationality over time, or rather the people who occupy this room. So it used to be the case that tons of people bought these things at exorbitant prices, and so let me just, and I'm going to show you some evidence of that in a real world, much bigger stakes market that probably hasn't changed over time, but basic math. And actually, this is kind of a life lesson. You should actually be prepared to do this math on the spot when someone offers you an extended warranty or if you rent a car and they give you a collision damage waiver. So as of 2013, this online company called Square Trade had a 2-year plan that cost $125, and it was basically a 2-year extended warranty for a 64-gigabyte iPhone 5, which at the time cost $400, and now it's probably worth about a pack of chewing gum. Okay, so it had a $100 deductible, right? So where we got it was basically just replace the phone. So the expected value, not including the cost, was equal to the probability of loss times $300, right? Because basically, if you have this thing and you lose your phone, you buy another one for $400, the deductible is $100, they're actually giving you $300 towards your new phone. Plus 1 minus b, the other possibility is that it's worth nothing to you because your phone never goes on the fritz, okay? Which is whatever it is. And so the rule becomes you buy if p times 300 is greater than 125, right? And that will be true if p. This is sort of the dollar maximization as opposed to utility maximization. This is in the absence of risk preferences. So if you're completely risk neutral profit maximizer, the rule would be to buy if the price was if the probability of loss was greater than 125 over 300, which equals 0.42. So for this thing at the time to have made sense, you would have had to have believed in the course of 2 years there was a 42% chance that your iPhone 5 was somehow going to get demolished. And if you really thought that was the case, you would have done better buying an OtterBox. I think mine cost $18. So what winds up happening, right? And very few of you said that you thought the problem. Now I don't know the terms of the extended warranty. So I'm not going to sit here and claim that 31 of you made a mistake. But the fact of the matter is that vast numbers of people take out this kind of small stakes insurance, and almost certainly it's not a good idea. Okay. Now there was something else I wanted to say here because I'm going to convince you that it really isn't a good idea. Shoot, how do I want to get there? Okay, so just take a bit of a shortcut. So one possibility, right, for the reason why Square Trade was able to make money off of this deal, one possibility is that there actually was that high of a chance of smashing up your iPhone. Another possibility is that you were just wrong about the probabilities and you legitimately thought that the probability was that high. And another possibility is that actually you are that risk averse or loss aversion. But even under any of those circumstances, here's an additional question which just foreshadows where we're going in a minute. How many times do you buy a piece of consumer electronics of roughly that value in the course of your lifetime? Right? Scores of times. Right? So shouldn't you be taking all of those risks into consideration when you decide whether or not to take on this risk? What we're really talking about is your portfolio of risk. And that brings us back to what Alex said in the first place, right, which is you should really be thinking about the big picture. So where we're going here is that in addition to loss aversion, we're going to find ourselves stumbling into something else that comes up when people make these kinds of risk choices, which is that they tend to ignore the fact that each risk choice is embedded an entire lifetime portfolio of risk, including the risk that, like a fluorescent light bulb will fall out of the ceiling and hit you on the head. Okay, so now let's look at some real-world evidence. So this is Justin Sidner, and this was his dissertation when he was here getting his PhD. He shows that people pay far too much to insure against what in this case was a $500 loss. So here's where he went looking for evidence, real-world evidence. He got data on homeowners' insurance choices and their outcomes. So he found some big insurance company that was willing to just give him this massive data set that included the following pieces of information for each policy holder. What deductible did they choose from among $1,000, $500, $250, or $100 deductible? How much did they pay to reduce the deductible below $1,000? So how much additional premium did they pay to get the lower deductible? And then what percentage of homeowners actually made a claim on their policy, which is to say what was the percentage rate at which people actually had bad things happen to their home? Okay? So what we're talking about here is small stakes. This is insurance against small losses in the following way, right? We're talking about an insurance policy that's going to cover up to some hundreds of thousands of dollars worth of damage to your home, like your house gets burned to the ground. And the question is simply how much of that are you going to bear? 500 versus 1,000, let's say. Okay? Which is tiny, right? Relative to your wealth, relative to the value of the house, relative to the value of the policy. So we can think of this as a small stakes gamble of exactly the same size as the one that I was asking about a minute ago. Okay, so here are the findings. The typical homeowner, and I apologize, I don't actually know what Sidner meant by typical. I don't remember if it was modal or mean or median, but the typical homeowner, roughly speaking, that's driving me nuts. Oh, well, they say complaining doesn't do any good, but in this case it worked. The typical owner paid $100 on top of the baseline premium to lower their deductible from $1,000 to $500 when the actual observed claim rate on policies of this type was 5%. Okay? In other words, they paid $100 for insurance with an expected value of under $25. Okay? The average homeowner, so obviously typical didn't mean average, paid 5 times the expected value of a lower deductible across all deductibles. So this was the typical homeowner. Okay, so I see what that means. Most of them chose the 500, and then this average one is across all different deductible choices he computed. They multiplier on how much above expected value they were willing to pay. Don't do that in your life. For the expected utility model to explain this degree, so again, this is sort of the plausibility argument, the owners would need to be 200 to 1,000 times more risk averse than typical estimates. Right? So people have gone out and used all kinds of data on people's risk choices to estimate the curvature of this thing when we're trying to explain large stakes risk preferences, right? Like life insurance, home insurance. This is $500 stakes. This is small stakes. So in order to explain this, we would need risk aversion vastly higher than what we have observed in many other studies, which puts them in the realm of, like, I would reject at 1,000, a bet if lose 1,000, gain any sum. Okay? So that's real world data. Now I just want to point something out. This is kind of an aside, but it's an important aside to me. The profit, right? All the firm cares about is in expectation what are they going to pay out, because they've got thousands and thousands of these policies. So on average, their payout is going to be $25 for the lower deductible. And so they're making a profit on each of these things of $75. Okay? Question to you is that ethical? This is just an aside. This is just something for you to ponder. It's the kind of thing that I think about as a behavioral economist in public policy. You could say, well, look, people make their choices in the marketplace. But if their choices are based on some kind of odd thing going on in their heads, it's not obvious to me that we should, as a society, really empower insurance companies to make that kind of money off of simple mistakes. And you might think, well, $75 for a typical homeowner is not that big of a deal. There are 75 million homes in this country, and if each one of them makes this mistake, then we're talking about $5.6 billion annually just from the lower deductible. Okay? So that's just something to think about from the standpoint of public policy. The reference depends model, the heroine always wins in the end, right? That's one, you can guarantee that. The behavioral model never fails in this class. So we think about the way we think about this is that homeowners make their insurance choices based on their possible gains and losses, damage versus no damage to their home, relative to the reference point of the expected net loss at the time of the loss, right? So they're projecting themselves into a future in which their home either does or doesn't burn down, and they're thinking, okay, if I get the insurance policy, then I'm going to get the expected value. If I don't get the insurance, and then that will become my reference point. If I don't get the insurance, then I'm looking at potentially massive loss relative to my reference point, or a gain relative. So a little bit this depends on whether their reference point is the expected net loss under insurance, or whether it's just their status quo. So if it was their status quo, they're putting themselves in the future, and they're thinking, my reference point is going to be that I have a house. If it doesn't burn, that's no gain. If it burns, that's like this massive loss. At the time of the loss. Now, by the time of the loss, right, the premium is paid way in advance. So if I'm projecting myself into the future, I predict that I'm going to adapt to the loss of the premium. I'm paying the premium now. I'm going to get used to that. It's not going to be part of my reference point. So I'm not going to feel loss aversion in the future, which means that my reference point is higher than if I didn't adapt to the loss of the premium, which means that, right, so people correctly predict that that's not going to enter into my gain-loss utility. So the prospect of losing that extra $5 in the future feels particularly large. Okay? Putting myself into the future, my house burns down, and the question is, do I pay the first $500 or the first $1,000 of that sort of $200,000 cost or $800,000 cost? If you have loss aversion, you project into the future and you say, ooh, I'm going to hate losing that extra $500. That's going to be a big deal relative to my future reference point. Okay. I'm not going to go into this. You can read the paper. There's one of the things you have to do when you're writing this kind of paper. Economists, the way that we have fun together is that we invite somebody to come and present their results and tell us what they think the results mean, and then we all sit around coming up with other ways that their results could be explained. Right? We all come up with like these complicated things. Well, what if that person was actually from Guam, where in fact we know that risk aversion rates are quite high? It's just crazy stuff like that. And so you have to go around and you have to rule out all this stuff. So there were all these different alternative explanations that Justin successfully ruled out, which increases our confidence that what's going on here really is loss aversion. Okay. Another example. Also, by the way, any guesses on whether or not market experience would drive this particular piece of loss aversion out? If you're a salesman, you ought to know what's going on here. But if you're a homeowner, you're likely to buy home insurance probably only once or twice in your life, right? So now, if you actually buy a new house every year, is that right? Every other year. Okay. Now you might say, but they ought to reconsider it every time they sign a new policy, which is annual, right? Or not every time they sign it. They ought to revisit it all the time, think about it. But that's not the way people make most of their decisions. You make this decision about the deductible, and then you move on. And you make this decision only a couple times in your life. Okay. Another example, the equity premium puzzle. Has anybody here studied finance enough to know to have heard of the equity premium puzzle? Okay, I'll explain to you in a second. Question?
When people buy a house, it's just such a huge expenditure for them that if you add on an extra $100, like $2 million for that,
this actually makes the problem even worse, right? Because what we're talking about, and this is something else you've got to really watch out for in life. So I'm like way into the realm of losses here. And what's happening is that because you've already hit me with some big chunk of loss, the additional loss of a little bit more premium, I'm into diminishing marginal sensitivity, I don't care.